AGG ETF is a very popular ETF that is found in many investors' portfolios. Today we're going to talk about the pros and the cons for AGG. The pros are that the fund is very cheap. It only costs 3 basis points. The fund is highly liquid with over $120 billion in the fund, and the fund offers a good diversification benefit. Notice that I didn't say great. It offers a good diversification benefit. The cons are that the fund offers no inflation protection, and currently the fund has a negative yield after you account for inflation and taxes. I have a great presentation lined up here, so I think you're going to get a lot out of it. We'll get into detail on the pros and the cons, and then you can decide if AGG is right for your portfolio. Let's quickly talk about AGG's composition. AGG is a bond ETF, 45% in government bonds, 26% in securitized, that's going to be mortgage-backed securities, 24% in corporates, and a little bit in cash. The maturities are 2% short-term, 56% intermediate term, which is 1 to 10 years, and then 41% long-term, which is 10 to over 30 years. This ETF is highly diversified with over 12,000 holdings. The expense ratio is very low at 0.03, and the dividend yield is at 3.74. The duration is 5.9. Here is the first con for AGG: no inflation protection. If you had invested $1 million in AGG at the end of 2003 when it first started trading and spent the income stream, today your $1 million of principal would be worth $960,000 over 21 years, and you have no price appreciation. Here is the AGG dividend over the last 21 plus years. Since inception, no growth in the dividend. In fact, it's down slightly from when it first started paying dividends. No inflation protection on the AGG dividend. On this table, I'm showing you what happened to a $1 million investment over the last 21 years as a result of core inflation. Your $1 million investment at the beginning of 2004 to keep pace with inflation today would need to be worth $1.65 million. Clearly, that wasn't the case with AGG if you made a $1 million investment back in 2004. Today, you're under $1 million on your principal if you had spent the dividends. If you had invested $1 million in AGG at the inception of the ETF, in your first calendar year, 2004, you would have received $35,035 in dividend, i.e. income off of the ETF. What I'm showing you here is how core inflation has impacted $35,035 in cash flow over the last 21 years. Today, at the beginning of 2025, you would need $57,878 in cash flow to equate to $35,035 back from 2004. So we already know that AGG income stream never grew over the last 21 years. Therefore, there is no inflation protection at all on your income stream from AGG. Another way to think about this is while the AGG dividend has been stagnant for over 21 years, the prices that you pay for energy, food, clothes, etc., all those prices have been doing this. They've basically doubled over the last 21 years while your income stream off this investment has done nothing. Here's how some people can get confused on an ETF like AGG. We're looking at the total return since inception. And what we're doing here is we're assuming $1 million investment at the inception for AGG and then reinvesting the dividends over the last 21 plus years. Today you would be at $1.87 million. But remember, we would need to be at $1.6 million plus to keep pace with inflation. If you accounted for all the taxes that you would have paid on all of the dividends over all these years, you're going to be behind inflation with this investment. Don't let money illusion fool you. When you look at something like AGG, you need to account for inflation impact on both the principal and the dividend like I just showed you. A simple yield analysis on AGG demonstrates that you are losing money just to hold the investment. The AGG dividend yield is 3.74. So if we assume that you pay 30 cents in the dollar in taxes, you get to keep 2.62% after tax. That's your after-tax yield. Then back out core inflation. This is the core inflation number for December of 2024. You are at a 0.62 negative yield after we adjust for inflation and taxes. Now let's investigate why you might want to own AGG despite the fact that AGG has a negative yield and no inflation protection. We're looking at the returns for a couple different investments in 2008. December 31 of 07 to December 31 of 08, the last major recession. The SPY ETF, that is the orange line, lost 36.81%. We're looking at total return. So for 2008, S&P 500 proxy, SPY, got crushed. If you had a 60-40 portfolio, you lost 18.92%. If you were 60% SPY and 40% AGG. And if you only owned AGG, you finished the year positive total return 7.9%. This is why, this protection right here, why people want to own something like AGG, because they are hoping that if there is a crash in the future, that the investment may go up in value and give them some downside protection. For perspective, here's a look at the 2008 percentages using a $1 million investment illustration. We start 12/31/07 with $1 million in AGG, that's the purple line. At the end of the year, we've got 1.079 million. We start 12/31/07 with $1 million in 60% SPY, 40% AGG, and we finish the year with 810,000. Or we start with $1 million in SPY ETF and we finish with 631,000. For some investors, especially those who are highly risk averse, having something like AGG in their portfolio that might offer some protection in a recession when the stock market crashes is very desirable. Some people will look at this and say, wow, in a crash, I'd rather end up at 810,000 than 631,000. In recent years, AGG had a 20+% drop peak to trough, and that's because of rising interest rates. In the last 3 years, AGG has had a fairly high degree of correlation at 0.73 to SPY, the S&P 500 proxy. Some diversification benefit there, but not much. If we extend the analysis to 5 years, notice that the correlation goes to 0.57 between SPY and AGG. If we go even farther to 10 years, we see the correlation between SPY and AGG goes to 0.37. Good diversification, but not great. If you don't know how these correlation coefficient numbers work, let me quickly explain. Correlations between two different investments range from +1 to -1. +1 indicates perfect positive correlation where two investments are moving in lockstep. They're moving in tandem up and down together, i.e., no diversification. -1 would indicate complete inverse relationship where one is going up and the other is going down like a teeter-totter. Ideally, for your portfolio, you want to have investments that are at or near zero, meaning they could be going up, down, or sideways and are not related to the other investments. That would be very good diversification. In the case of AGG, with a 10-year number at 0.37, we're in the moderate category in terms of diversification. AGG is giving a moderate diversification benefit against the S&P 500. And in my experience, that is what investors want when they talk about diversification. They're looking for some sort of protection from a crash in the S&P 500. Here's how interest rate movements and duration affect AGG returns. If you had $100,000 in AGG and interest rates were to go up by 1%, we know that the fund duration is 5.9. Therefore, you can approximate a $5,900 loss for a 1% move in interest rates up. If interest rates were to go down by 1% and you had $100,000 in AGG, you take your 5.9 fund duration and you calculate a $5,900 return from interest rates going down by 1%. In this table, I'm showing you your worst case and best case for a $100,000 investment. We're looking at 2 standard deviation loss or 2 standard deviation gain based on the standard deviation of the last 3 years, which was 7.46%. I'm using the AGG expected return of 3.74 using the current dividend yield, and then going 2 standard deviations above or below that expected return. 95% of your return experience is likely to be between these 2 numbers going forward. A couple other things I'd like to point out. If you own AGG with a robo-advisor or a financial planner and you pay advisory fees or commissions, then you're going to have lower returns on AGG due to those fees and commissions, because those would be in addition to the 3 basis points that you're paying to the fund manager, which is BlackRock. AGG has another unique risk that you need to be aware of, and that is that the ETF has no maturity. Unlike buying treasury bonds, for example, that mature in 5, 10, 15, 20 years, whatever maturity you pick, where you will get your principal back when those treasuries mature, AGG has no maturity. So in theory, if interest rates keep going up, you'll keep losing on AGG. Now, your cash flow may go up as they roll over bonds in the portfolio, but I think there's a good chance you would do better by creating your own bond ladder versus owning an ETF like AGG that has no maturity. If you have questions about your investments, please give my office a call. We would be happy to give you a second opinion on your portfolio. So let's add it all up. AGG has pros and cons. The biggest con, in my opinion, is no inflation protection. The biggest pro, in my opinion, is that AGG may provide you with a nice diversification benefit in the event the S&P 500 were to have a crash. If we enter a recession, interest rates go down, and people flee into fixed income, AGG may go up in price, and it may lower volatility in your portfolio. Of course, this is all on the if come. We don't know. It is also possible that we could hit a recession, and if we have more inflation, interest rates go up and AGG goes lower while the S&P 500 goes lower. So keep that in the back of your mind. Nothing is guaranteed when it comes to investments. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.